How do transactions change the accounting equation? This is going to be a continuation of yesterday's video. Yesterday, we spoke about the accounting equation and essentially established what it was and what it's for. Today, we're going to get deeper into the equation, and I'm going to speak to how transactions or any other kind of business activity impacts this equation, okay? So we established that accounting is essentially a representational system. Companies are always doing things. They buy things, they sell things, they take on debt, they create assets. Companies are always engaging in economic activity, and we need some kind of system that will allow us to represent this economic activity. Okay, we know now that we have the accounting system, and we use this system to represent this activity. And today we're going to get into essentially the foundation of the accounting system, which is the accounting equation, as you might imagine. So accounting exists to represent economic reality, and this equation organizes that representation into resources. Okay, and we know resources are going to be termed assets, and essentially claims on resources, which is going to be the right side of our beloved accounting equation, which can be further decomposed into liabilities or obligations and residual interest or equity. Okay. Now, we know what the accounting equation is, and we now understand this equation to be sort of a static entity. But I'll have you know that this quote unquote static entity is going to be updated by business activity. So today we're going to cover what actually happens when a business does something, okay? Now, as I just stated in the previous slide, this equation captures one moment in time, okay? You could think of it as a snapshot, a literal photo at a specific point in time, okay? So if we were to look at this company's financial position as of right now, we see that they have assets of 100K and they have liabilities of 40K and equity or residual interest of 60K. Okay, that's their financial position as of right now. Okay, this is where they're at a present point in time. Every transaction produces a new snapshot, and this is the main thing that I'd like you to take away from this video. So we have our initial snapshot. To go back to our example here, this is snapshot at point in time t0, we could say. Okay, so this is our initial financial position. Transactions, whether that be the company bought some kind of asset, they bought some kind of equipment. Let's say they took on debt. Let's say they received a payment from a customer. I'm using the word transaction to essentially encompass all kinds of all the differing kinds of business activities that a company can engage in. Okay, transactions create a new snapshot or essentially update the original snapshot, and that's the main sequence that I want you to get here. So, if something changes economically within the business, the accounting equation is essentially going to change its representation to track that change. That's the best way to consider it. Okay, now to make this concrete, let's walk through a couple example transactions. So let's say that the business owner contributes $100,000 of cash to the company. This is transaction number one. At the bottom of our screen, we have assets equal liabilities plus equity. Okay, this is our beloved accounting equation. So cash is an asset. So as you might imagine, assets increase by 100K. Liabilities are going to remain unaffected here because this is the owner contributing these resources. Okay, if the owner contributes resources, that's going to be recorded as equity, an increase in equity. And so notice that the accounting equation remains in balance, and also notice that this transaction updated the equation. Okay, so the equation had an original state, it had a prior state. This was the equation had some amount of assets, liabilities, and equity at point in time t0. The transaction comes in, and now we have a new snapshot. Okay, that's the main pattern that I want you to understand here. Now let's look at another transaction. Let's assume that the company borrows $50,000 of cash, okay? This is going to be different from our original transaction, the first transaction that we covered, because this is not an owner investment. This is essentially a creditor providing these resources. So again, we have assets equal liabilities plus equity, okay? Now cash, again, is going to increase because Of course, cash is an asset, so assets are going to increase. Liabilities are actually going to be affected here because the company is borrowing these resources, okay? So liabilities are going to increase by 50K. And then, of course, equity is going to remain the same. Equity is not go- going to uh, going to change here, but we still have that $100,000 in equity from the previous transaction. Okay, so again, same pattern. We have snapshot one, the original financial position. Then we have a transaction that's essentially going to update the accounting equation, and then we have our new updated equation or updated financial position. For transaction number three, let's say that a company buys equipment worth $20,000 with cash, okay? Now, this is a rather unique transaction because claims aren't going to be impacted here. Liabilities and equity aren't going to be touched by this transaction. Only total assets are going to be impacted by this transaction. And let me show you what I mean by this. So cash is an asset, and cash is going to leave the business. So cash is going to decrease in this transaction. Equipment, which is another kind of asset, is going to increase. Okay, so the net effect to total assets is going to be zero. Okay, that's why this is a unique transaction, but the accounting equation is going to be updated by this transaction nonetheless. The company is still going to store this transaction within their accounting records. We have a couple more transactions that we need to cover today, and then we'll be good. So bear with me here. Let's go through these last three transactions. So let's say a company buys equipment worth $10,000 on credit. And whenever you hear someone say on credit within any kind of business context, it either means that the company didn't pay up front or the customer didn't pay up front. Okay. If you are extended credit, it means someone wants you to pay them later. Okay. So we bought equipment, and that equipment is going to be recorded as an asset on our balance sheet. Okay. So assets are going to increase by 10K. Now, accounts payable, which is essentially the liability account we record on the balance sheet whenever we have been extended credit, is also going to increase. Okay, so we reflect that fact in our accounting records as well. Okay, when the company settles this obligation, when the company pays this payable, cash is going to decrease by $10,000. So cash is an asset, so assets are going to decrease. Now, liabilities are also going to decrease as well because the company has settled this obligation. They no longer need to record it on their books. They've made good on their promise, okay? So liabilities are going to decrease as well. And the last transaction that I wanted to cover today was another interesting transaction. Let's say that a customer pays a $5,000 receivable. Okay, so cash is going to increase because we collected cash from our customer, and receivables are going to decrease. Okay, now these are two asset accounts. So again, this is another kind of transaction where total assets are going to remain unchanged because one asset is essentially becoming another. Okay, so the main takeaway from this video, just to kind of synthesize everything we've gone through, is the fact that the accounting equation, which is assets equal liabilities plus equity, represents a company's financial position at a specific point in time, okay? And this equation is not static. It's subject to update when it is exposed to a business event or transaction, okay? So state one, okay, state one of the company's financial position is going to be updated by business events, and that's going to lead to state two. State two is going to be updated by business events, and of course that leads to state three, so on and so forth. And we're going to get deeper into what this actually means within this course, but that's the main takeaway from this video. So just understand that economic events are essentially going to be modeled by a company's accounting system, okay? And that accounting system is going to organize this information within the accounting equation. Now, if you like this kind of stuff, definitely consider subscribing, comment if you have questions, and stay tuned. Thank you.